Welcome back to the course An Introduction to Commercial Banking and Fintech, and in this particular session we are going to discuss some of the important aspects related to the risk weighted asset that we have already discussed when we were discussing the capital adequacy ratio, which was the total capital upon the risk weighted asset. So in CAR, when we were, so here we had the capital adequacy ratio CAR, and in this we solve for the CAR. CAR became what? It becomes the total capital, which is CT upon risk weighted asset, and total capital included both tier 1, which is the main important one, and tier 2. So this is what we had, the RWA, and this we call it as the CAR. So this we covered already. So RWA is nothing but, here it says about the exposure I into the risk weight that here we have, right. So why RWA? Because if you are not going to assign weights to your different exposures that you have, then it may happen that you are having the asset, but on the risk side it may be having a different impact, and if you are more on the risky side, if something comes in or you have a shock appearing, then your bank will be in trouble. For example, I have mentioned here that rupees 100 crore corporate loan is riskier than rupees 100 government bond, and this is what implies. And capital is required against risk adjusted exposure, not total assets. And risk weighted asset aligns capital with the risk profile of the balance sheet. This is what the gist. So this is linked with this, that how it is riskier. So this is what here we have. Global approaches are standardized approaches. So fixed risk weights by exposure class rating. So this is what here we have. IRB, another, is the internal rating based approach. That is the most important clause for the Basel II. Under that, here you have probability default, loss given default, and exposure at default. So PD is related to risk weighted, so probability of default. So this you can calculate using different types of methodology. Probability of default, LGD is nothing but loss given default, and EAD is nothing but exposure at default. Right. So here you have probability default, loss given default, and why it is important? Because risk weighted assets will have the assets like the bank has exposure to retail credit, then mortgage, then here you have the, you can say, durable goods. Then here we have further, you can think about corporate loan, right. Now probability default or exposure default and all these things are related to these exposures. So in Basel II we magnified this further. So risk weighted asset that earlier it was used for in capital in Basel I era, it took the exposure in Basel II era, and majority of the things were focused on this, and this created whole lot of new kind of job in the banking sector. Earlier banking sector jobs were mostly desk based, but after the invention of new technology, internet banking, and also the electronic ledger and electronic KYC norms, all these computer application in the banking sector. So we saw that there was a chance to go for internal rating based system, and the majority of the banks, if they have exposure, they used to measure their own risk management through these techniques, and they were able to control on the default and on further on the SMA accounts. So this is the reason why RWA is worth discussing here. So for example, RWA, suppose here we have the corporate loan is 100%, for example, it is having 5,000 crore. Retail loan is 3,000, so it is having 75% weightage. Government security, so risk weight is 0, so it is 2,000 crore. So RWA will be what? It will be 5,000 into 1 plus 3,000 into 0.75 plus 2,000. So it is going to be 7,250, right? So this is what it implies. If total capital is equal to rupees 1,200 crore, so capital adequacy ratio will be what? It will be 16.55%, right? So this is what it implies. So CAR is equal to how much? It is 1,200 upon 7,250. So it is going to be the 16.55%, and this is what we get here, right? So a strong capital buffer relative to the risk weight observer. So if you account for, suppose total capital is 1,200 crore, so then we are saying that risk weighted asset is 72. So bank is healthy, right? It is having, so in this case 16.5%. So, and if the Basel 1 norm, suppose RBI says that, if this is the case for SBI for example, and RBI is saying that you maintain 10%, so bank is having buffer of 6.55%. So this is what it says. So it means that 16.55% is greater than 10% of regulatory, right? And this implies that bank is safer and healthier, right? So this is what we have. Then here we have the capital adequacy ratio versus leverage. So why regulators use backstop? So here we have RWA depends on risk weights and sometime internal models, right? Suppose we have two banks, same total exposure 10,000, same tier 1 900. So bank A has the RWA 6,000 and tier 1 is 15% in this case, because tier 1 is 900 upon 6,000, so it comes out to 15%, right? Here we have the 4,000, and here you can see we can put the same, right? So here we have the 900 upon 6,000, and here we have 900 upon 4,000. So here you can see with the same risk weight, or change in the risk weight, we are seeing that we are able to manage the total CAR very easily, right? So and this is what here we have. So leverage ratio, even if you calculate, so it is 900, that here we have tier 1, so leverage ratio is this, and upon 10,000 is the total exposure, so it is coming out to be 9%. What is that? So which means that leverage ratio, as you can see, that it is linked with the total exposure. So total exposure is 9%. So tier 1 exposure to total exposure is 9%, but with 9% of the total exposure of tier 1, we are able to say that our adequacy ratio is 15% and 22%, and this is what is the challenge, that even though the leverage ratio is much lower, just 9%, but you are able to quote in terms of capital adequacy ratio more, 15% and 22%, and this is where the challenge comes in for both banks. So here the idea is that banks can play a role. So leverage ratio prevents banks from appearing well capitalized purely by lowering RWA. You can see that if it is 8% CAR, so your leverage ratio is also, based on exposure, it is also just 9%. It is on the riskier side, because tier 1 capital is the most important one. So it should be at least 20 to 25% or 50%, then you can say that bank is not risky. But here bank is risky because 10,000 is the total exposure of loan. It may happen that out of this 10,000, bank can have the default on 5,000, right? So if 5,000 is the default, so how will you will have the risk absorption or of only up to 900 crore. So you have to go for liquidation then, right? And this is where the tier 2 capital need arises, and then you will be moving to tier 2. And this becomes the challenge for majority of the banks that we see in modern times. Then what are the further loopholes? So model risk that we have, the probability default and loss given default, it also so these are based on statistics. So PD we can calculate through probability models, like for example we have the subjective probability models mostly done through, you can say, the cross sectional models, right. So logit, probit, here we have logistic regression. So this whole Basel II post 2004, we saw a lot of analytics job appearing in the banking sector. Why analytics job? Because internal rating based created a whole lot of job in the, so we saw HSBC hiring a lot of economists, statistician people and others, because they wanted to do this exercise, internal rating based, because when they were they wanted to have the accurate picture of RWA, that how much I have to give. So they started creating the capital adequacy not just for the overall but also for their loan basket. So suppose if you are working with Bank of America, they have operation in different countries, you may be getting data on KYC norms of Mexico and other locations, and you do regression approach and then try to analyze and give the probability estimate that what is the weight that you will be giving to that. So for example, 1 million loan exposure will have one group, 2 million exposure will have one group, 3 million will have one group, 4 million will have one group, and then based on that they decide the weightage criteria. This is what shifting into low risk weight assets without reducing the risk tail risk. So high risk, that here we have pro-cyclicality, risk weight rise in downturn, we know, and downgrades and tightening credit. So this is also right. Asset quality review that we did in 2015, that created a lot of emphasis on the risk weightage, that how much we have to give. RBI conducted this, and it was also linked to the non-performing assets. Then here we have the provisioning discipline. How do you go for provisioning, whether it is okay to have that kind of risk or it is not. So those things were part of capital planning. So capex of the banks were also tied up with these kind of risk weightage. That recently we have heard that since independence we did not focus much on the micro loaning, but post COVID it has happened that RBI is experiencing unprecedented rise in the micro loaning segment. As a result, you can think about banks were not paying attention to macro loans, but now as per the new guidelines of the RBI, banks have to maintain a record of the macro loaning and how much they are giving, what is the default rate, and based on that their RW will be also adjusted, because this is what the overall scenario looks like. So asset quality, provisioning discipline, how much you can provision, how much you have to showcase on balance sheet, how much you can go for write down. So those kind of thing, capital planning. Stress testing came post Basel II. Stress testing, maybe I will have one session on stress testing, that how it is done in case of bank, but normally it is an Excel sheet exercise where you need different types of indicators to test. The best thing to read about stress testing in case of India is the Financial Stability Report, FSR, available on the RBI website. You can go there and check how RBI conducts the stress testing, with what scenarios and risk weighted, what weight portfolio they calculate, and concentration risk is another. So here we have the capital quality, credible RWAs, and forward looking stress and others. So what we have to remember, so tier 1, CET1 plus additional tier 1 is going concern capital, tier 2 is the supplementary going concern buffer, and this is what here we have. CET1 is the highest quality capital, and it also observes the losses first. The risk weighted assets, it converts into the, it is the denominator for the CAR, total capital upon risk weighted, so it bounds to create. So if you want to have lower CAR, if the RW weight is higher, your CAR is going to be lower. So in order to increase the CAR value, you reduce the risk exposure, so maybe you will go for securitization and other options. So this is what here. So and leverage ratio and stress testing creates further a good impact on the scenario. So this is what, if you think about the limitations, so these were that mostly we found that the risk weighted assets were in 4 baskets, 0%, 20%, 50%, 100%, and there was no differentiation within these categories. So OECD bonds and others were having the all corporate loans treated as equally risky, and further There was also the credit rating differences. For example, AAA corporate bonds in India are called risk free, but here it was not mentioned clearly, and this created further trouble later, right. So, this is what we imply. And these are also the further risks that we thought it also played a very important role, and I think I have covered most of the things. So, you can go through this slide. Now, let us move on to Basel II in a very detailed way. So, Basel I looked too simplistic because CAR was the only concern, but in CAR the risk weighted asset created further trouble because banks are able to manipulate with the change in a denominator and numerator. Sometime in numerator also they played a role to see the increased number, and no operational risk was mentioned. So, operational risk were added. Regulatory arbitrage through securitization was the one aspect. So, what was the objective of the Basel II norms? So, it was actual economic risk, how much they have, internal capital management, how much they get, and market discipline. So, these were the and three pillars that we often read is this. Pillar 1, minimum capital requirement, which is linked with credit risk, market risk. VAR that we are seeing, it is nothing but it is called value at risk. How much you have the with the given level of confidence, how much you think that you will be able to lose your money. So, this is where VAR based model, and operational risk that were added later. Supervisory review. So, internal capital adequacy assessments were the important document. Stress testing and governance oversight became the important contribution of the Basel II. Supervisors may require additional capital. So, that were also the important that later became part of the Basel III. So, this was also. Market discipline was one important aspect which mostly related with the disclosure requirements, transparency of risk exposure and capital structure, and there was some kind of discipline on the investor and the funding cost. So, this is what we have. So, credit risk, what were mentioned here. So, in terms of credit risk in Basel II, it was mostly the standardized approach, and second was internal rating based approach, and under this the further important things were, for example, credit risk. In Basel I, all corporate loans had the 100% risk weight. So, there was no differentiation, there was only 0%, 20%, 50%, 100%, and 100% was for the corporate loan. Basel II introduced the risk weight linked to borrower credit quality, and this is where nowadays if you go to bank will ask you KYC, right? They ask for KYC. So, KYC came after the Basel norms because this credit quality became the important norms. So, now we have eKYC, right? Now, because of internet, majority of the banks and financial institutions they go for eKYC, which means that they want to know from you that what is your credit quality, how much details you can reveal, and based on those details they will be confirming you and your credit ability, that how much you can borrow from the bank, right. Internal risk modeling, as I mentioned, that this created the whole lot of job market scenarios in India and abroad everywhere. So, banking sector jobs are mostly linked to what we call it internal risk modeling. Internal risk modeling basically implies that we are talking about the KYC data analysis based on different kind of statistical modeling and trying to predict that what is the churning rate and how much is the probability of default on a particular segment of a loan, how much it can have the impact, 50% of people are going to default or less, and it can be also linked with the macroeconomic scenario and explicit recognition of default probability. So, these were the major contributions. So, in Basel II we saw better risk management and better capital allocation because of the credit quality that we mentioned here, right. So, under you can say credit risk capital, here we have the standardized. So, risk weights based on the, so external credit risk rating agencies also came up, sprung up during this period. So, this was also the, for example, in India we have CRISIL, then ICRA is also one organization that does the rating. Then here you have the global rating standards, S&P, Moody's and others. They started giving weightage to credit ratings. If you have AAA, good quality, low risk, risk weighted. The definition of risk free asset comes, it also comes through rating, but the proper definition of risk free asset is the asset which has low or zero standard deviation. If an asset has low or zero standard deviation, that qualifies to be a risk free. And these weights, so you have both, you can calculate this internally, but external agencies, some kind of assurance was required. So your credit quality will be assessed by external agency will be giving you weightage. That weightage will have a higher value and higher recognition, credibility, and this created a whole lot of market. So we can see that whole banking sector started getting attention in terms of credit rating only after this. Then internal rating based had a great chance. What were the internal rating based? First was probability of default. How can I, whatever data I have, can I calculate the probability of default of certain number of borrowers internally, and can say based on whatever information they have given, collateral value and all others, that there will be default on this particular account. Loss given default, that how much I have the loss if the customer has defaulted, which means that I borrowed 8 lakh rupees from the bank, I paid back 3 lakh rupees, I defaulted on 5 lakh rupees now. So loss given default for the bank will be 5 lakh rupees, because 3 lakh bank has received already. Exposure at default, which means that how much is the exposure. So exposure can be in this case will be the 5,000 that we have got already. And a loss given default is like whatever is the earning that you had, only 5 lakh rupees that you will have. Or you can see if you are selling that asset to someone else, suppose at you can say 3 lakh rupees, then 2 lakh rupees again is the loss, right. So this is what you have. In case of car, suppose I purchase a car from loan and I use that car for 1 year, I default. So on default, what was the depreciated value of that car, whatever the amount that you have borrowed, whatever you have paid, and if the bank sells to someone else at certain amount, then the loss that has been incurred by the bank will be called as the loss given default, right. So this is what here we calculate. So these things are quantitative in nature, and lot of time statistical understanding is required to have the clear cut understanding about this, right. So here you have suppose bank A lends rupees 1000 crore each to suppose AAA rated firm has the risk weight of 20% because it is risk free relatively. BBB rated bond has the risk weight of 100%, and total regulatory capital is suppose 150 crore, right. So this is what the bank lend 1000 crore, regulatory capital is 150 crore, and weights are this. Compute risk weighted assets and compute capital adequacy ratio and interpret the result. So this is what we get. So here we have, in case of AAA firm, my risk weight is just 200. In case of BBB firm, it is 1000. So total risk weighted asset is how much? It is 1200. So this is what here we have, same loan size, very different capital impact. So this is what it implies. And capital adequacy ratio for this is, capital is 150 crore, risk weight is 1200 crore. So CAR is going to be 150 upon 1200. So it is going to be 12.5%, right. This is what we get here. So if I am having 1000 plus 12, so my CAR capital is just 150 crore and my CAR is 1200 crore. So I am having 12% of capital adequacy ratio, which is good, because as per the Basel you require just the 8%, but you are maintaining 12.5. So bank holds rupees 12.5 capital per rupees 100 risk weighted exposure. This is what you have. Higher risk weight on BBB firm drives capital requirement, and this is what you have. And Basel II differentiate risk by credit quality. So this is also one of the important reason. Apart from this, there is also one more term. I think I will be continuing this in the next session, which is like internal rating based approach. So under IRB, banks estimate key credit risk parameters. So first is the probability default, second is the loss given default, and third is the exposure at default. So this I mentioned, and your expected loss that you are going to see. This is the product of probability default multiplied by loss given default and exposure at default, and this is what we imply in most of these situations, right, and this is what we get. So overall what comes out that this is the overall, I would say, framework that we build up around. So let me give you the overall picture. So in the first session of the banking regulation, we touched upon the global banking regulation. In the second, we touched upon the Basel I norms, and we mentioned that the capital adequacy ratio, tier 1, tier 2 capital and risk weighted assets became the norm, and it came into mainstream. So majority of the banks started focusing on. CET1 became the major I would say contribution, because it became very important for the banks to monitor. In Basel II, what we saw that from macro level, the banks were told to look at the internal credit rating. So the rating system started, so whole credit rating business started. There was a role of internal rating approach, so benchmark. So you have the internal rating created, so IRB approach became important. Under that, we will see in the next session that how probability default is calculated, what are different measures, what is the meaning of it, and how it is done. And now we are in the phase of understanding much more detail, and those who are applying for banking sector jobs, these topics are really important, because when you are applying to HSBC, Barclays, any global banking, you need to have the understanding from Basel I, Basel II, Basel III onwards, because majority of these banking jobs are concentrated in the measurement of internal rating based approach and also the standardized approach. You should know good about the credit rating, how it is done, what are the factors, can we build up the quantitative models. Similarly, in Basel II, when we have a lot of machine learning based method, random forest and others, so you can think about building up how to calculate probability default. I see in the banking sector, people are working for years running the logistic regression or different types of data. So with this, I am stopping it here, and we'll be having the next weekend, the next lecture talking about further dimensions of Basel II, and maybe we'll be touching more on the internal rating based approach of Basel II. So thank you so much. Really appreciate your attention. I hope you are enjoying the course.